Coming up on today's edition of Women in Money, the shit we don't talk about, our guest is Matt Shanlian.
We are happy to have Matt with us today. Matt is the president of Primary Residential Mortgage, Great Lakes Division.
Yeah, today we're going to focus on women and why real estate is such a great investment for them and explore the impacts to community and building generational wealth.
Many times when we talk to Matt, he explains that homeownership is one of the key pillars to progress of women and their financial freedom.
Yeah, he always has a great perspective as to why we should be investing in our home and how to explore the different ways that women and their families can invest in themselves, in their community, and in homeownership.
This topic will be beneficial for women who want to invest in homeownership and the benefits to themselves and their families and for generations to come.
Let's do this.
Steinem once said, "We will never solve the feminization of power until we solve the masculinity of wealth." Barbara Provost and Maggie Nielsen are the team at Purse Strings that will help you navigate the ins and outs of financial independence so that you can be financially fearless. This is Women in Money, the shit we don't talk about.
Okay, so because this podcast is Women in Money, the shit we don't talk about, today we're talking about women, real estate, and the impacts investing in real estate has on your community. So let's get started.
So thank you, Matt, for being here today. For those of you who have never met Matt before, would you give yourself a little introduction and share who you are?
Yeah, absolutely. I really appreciate you guys, ladies, having me on. I serve as the division president for Primary Residential Mortgage. I've been in the mortgage industry my whole professional career, which is getting longer and longer, sadly, out of college in 2008. So I've been doing it for 14 years. And our focus of our company is a little different. I'm licensed in 49 states. We work a lot with financial advisors and their clients. And it's given us a pretty unique perspective on housing landscape more in a macro way, because we kind of work all the way from Hawaii to Boston and help clients achieve their goals, whether it's building wealth or accumulating investment properties. We've been really, really lucky to find this niche. So, and we met through a communal friend, Maggie and Barbara and I, a little over a year ago, and it's been such a fantastic relationship, and I'm just honored to be on.
Well, we are so excited to have you on today. For those who don't know, Matt is also one of our Purse Strings approved professionals. This means he's a professional who is part of our Purse Strings network, and you can learn more about Matt on our website, pursestrings.co. You just search out his name. But today we are so excited to jump into this discussion about home ownership and how it impacts the community. And I know this is one of the first things when you brought up. It was a very interesting perspective, something I've never thought about before. So, I mean, let's just start with, the vague question of how does it impact your community, the difference, I guess, of home ownership just versus renting?
Yeah, a great question. And it's such a large question to answer. There's so much nuance there. We can break it down a few different ways. I mean, like from a socio-economic standpoint, people that are in a community that own the homes rather than rent the homes are a multiplier generally by 3 to 4 times more likely to do things like vote in local elections, not just the presidential, but your county commissioners, your elected officials locally, your school boards. Not only that, but when you own a home in your community, you're generally sending your child to that community. If you have children, to the school district, there's more activity there, more pride in home ownership. So the values of those homes go up. They're not relying on a landlord to do the mowing or the upkeep or things of that nature. So there's a higher value increase on a percentage basis. But ultimately, we have a branch here locally, and one of our loan officers is really focused on this, and we call it our initiative like Buy Back the Block. People that are renting, buying the homes they're in, so that their community, not just from a neighbor standpoint, but from an elected official standpoint, from a community development standpoint, actually looks like them, actually acts like them, is interested in the things that they are interested in. And that becomes powerful, because that first generation that buys a home, that second generation, a home buying process isn't new to them. So it's intrinsic, similar to how education works. Like when that first generation actually gets the degree, that second generation doesn't, just implying they're going to college. That becomes the bar, not that doesn't come to the bar to achieve, that becomes the status or the
Mhm.
standard. So it is elevating not just that immediate community and the immediate home buyer, but it's the generational thing that the next generation and then therefore after home buying becomes part of their adulthood. And that just encourages, in even our government, and I know I'm kind of going off a little bit here, but our government this past year and a half, they've made a concerted effort to encourage first-time home buyers over multiple home buyers. So like people buying investment properties, multiples, Fannie and Freddie have altered some rules, made pricing a little bit more steep for those investment properties, and making the barrier to entry less, or excuse me, higher, so that when we're in a competition state for these homes to purchase, because we're all suffering from low inventory, that those first-time home buyers or their primary home buyers are going to have a higher stake or higher chance in purchasing because they want that over, communities being bought by, and I'm not saying that this is bad, but communities being bought by investors that are non-local or somebody owning 20 or 30 homes in a community. They would rather have each home be owned by a family.
I love that. And the word that just keeps resonating with me as you speak, Matt, is investment, and not just the financial investment, which of course is so important for a family to invest in their family, in their home, in real estate, in something that will grow in value, but investment in community, investment in neighborhoods, investment in the town center, the gathering places. And shared, like I always say, women build webs of influence. They reach across. And I think it takes, that takes a village to, when you do buy a home, you are raising a family, you are building community, you are looking for help and support, and you're looking to peers and others who can help, reach out across and the street, whether it be, or, the highway, whatever it might be, to help one another. So the whole idea of investment is, so powerful, I think, in this messaging.
And also when we think about, I kind of touched on it really quickly, but definitely in schools, in communities where it is very much more investor driven as far as the ownership, less likely for things like school levies to go through because those people aren't really in their own community. They're profiting off of it. And I keep saying this, I'm not vilifying investment homeowners. That's not the point. But when that person who owns a home is their primary residence and they build a family and they have children, they're going to be more apt to want to, support the educational efforts. Schools get more funding, levies pass, then education goes up. And you think it's kind of like the idea, this is a kind of a digression, but a friend that has a nonprofit where he drills wells in Africa. And his whole theory is once you can secure water, you can now look at education. Once you have education, you can now look at building. And so after water, the next building block of communities is generally education, because those kids that are going through, if they have the proper support, they are then going to come back and reinvest, and it grows. But if those communities are renter driven, I'm not vilifying it, but the numbers will always state that those communities are going to be the least funded school district, the least funded supporting, and those things, and those generations that come through have a higher hill to climb for success in their generation. So it is crazy how simple it is. Like buying a home and owning a home just sets up, not even on a personal economic wealth building, we'll talk about that later, but like in a community, a socioeconomic thing, sets up generationally how those schools, those communities, that development happens. And so we're a huge proponent of, especially like educating people who are renting, or first-time home buyers, or, specifically we deal with a lot of people like coming out of a divorce maybe and trying to understand their economics of buying a home and all those things. Like it's very, very important to understand how housing can play such an integral role in establishing a community, but also building wealth generationally.
It's foundational. It's foundational. And I believe that also as women, we are role models for our children and our families, and setting that bar, that expectation that, we have a home, we participate in our community, we help one another out, we're active, we volunteer. And when our children grow up, the expectation is that they will then do the same. And that just leads us to a rippling effect of goodness, right, for everyone in the community and ultimately in the world.
Absolutely. Absolutely. And even, if we want to take it down the road of like the economic and wealth building pathway, just if you just take the last 3 years as an example, we have seen unprecedented growth in home value in a year over year for about 3.5 years. And so a lot of people are seeing houses that they bought in 2018 and 19 for, let's say, 200,000 be now worth almost $300,000.
Yeah, wow.
Across the country. And so we talk a lot about understanding that some people are dead set on saving 20%. Like, I'll buy a house when I can have 20% down. And we look at that and you say, well, okay, well, I was looking at a house for $200,000 in 2018 and I started saving 20% of that. Well, that's $40,000. Well, now
that's a lot.
The house is worth $300,000 to buy the same house. Now you have to save $60,000 to get there. Or you could have only bought it for 5% down or 3% down. And then that growth would actually now have you over that 20% threshold, and allowing the house to do the work for you instead of doing it out of your own pocket. And so there's a lot of wealth building as far as equity in your home, which equity gives you power to pay things off down the road, like maybe some school debts, or if you get, some credit card debt or installment loans, to right size your budget, create cash flow so you can invest strategically. Or we have some people use their home equity to buy that first investment property. We just said that those aren't good, but sometimes those passive income things can be great, or buying a duplex and living in half of it and defraying the cost. There's so many strategies, but when we see this value escalation, meaning appreciation of homes, I hate to use the term free money, but it's free value. You do nothing for it except mow your lawn and, keep your house up. But the way the market is driving things, you're just appreciating and gaining value year over year on these homes.
It seems to me that home buying is kind of not a linear process in many ways. Sometimes the values of homes are so expensive, people can't afford it. We saw in 2008 the crash. We see now people cannot get their hands on enough of them. So I think really understanding what's happening with the market, you don't have to be the expert, but being clued in and talking to experts like Matt around, what's the best choice for me and my family now in this market, and really understanding that, because we do agree that investing in your home is important. It builds community. It builds so much for families. And then, Matt, you touched on this, and I'd like to explore the whole topic of generational wealth. We had discussed this at one point, and I'd love for you to share your insights and what you've shared with us in the past about the importance of generational wealth with home buying.
Absolutely. I don't want to sound the wrong way. We've coined this term over the years called strategic home equity management. And we work with a lot of our partners and clients and financial advisors because we view home equity as something that needs to have a plan to it. So many times families don't think of their home as anything but a place to live, and the equity inside of it they don't utilize or have a plan for. And so there's so many stories of people that, mom and dad pass away, and then there's 4 kids and 3 of them live in 3 states away, and 1 kid's home, and that kid has to mow the lawn and paint and get it up to sell, and then they have to split it 4 ways, and they just kind of leave the house to the next generation to figure out. And we try to work with our advisors where that home equity in the home either can be utilized to build wealth or protect wealth. There's products in later life for families so that the home equity can be used before the retirement savings, before things that are protected, maybe in a trust or an estate plan, and making sure that we are using money efficiently in those final days for that family. So not just the parents or the homeowners are taken care of and have their responsibilities taken care of, but the next generation doesn't meet undue taxes or lose money, and they are, because you would poll most parents. I mean, if you ask my parents who are in their 60s, they want to make sure that when they pass away, my sister and I are set up correctly. And a lot of times the home, you think about all the retirements and managed funds, those all get taken care of. And then the house kind of gets thrown to the side. And it can be such a great protection, or add-on so that you can build more wealth. So there's a lot of through lines to how that home can be a wealth builder through the accumulation stage, like while you're in your 30s, 40s, 50s, but also then having a plan in that 60s, 70s, hopefully 80s, now hopefully 90s. People are living longer. One stat that I tell every financial advisor, in 1992, only about 12% of people over the age of 62 actually had mortgage debt. So that means 88% of people had their houses paid off.
Wow.
I look at my grandparents. They bought their house in, I would say, the early 50s, I believe. They both passed away in the house. They paid it off probably 2 or 3 times, but they passed away with no mortgage debt. And I look at my parents. My parents bought a house 7 years ago, and they're now in their mid 60s. And so a lot of people are getting that retirement age with mortgage debt. It's a conversation that many generations haven't had. Right now, the number is a little under 50%. It's like 44% of families will now be dealing with mortgage debt into retirement. Does that delay retirement? Like, I'd like to retire at 64, but gosh, the house I still owe, so maybe I can try to stretch it to 68 or 70 because, got that $1,500 payment or the $2,000 payment. We're trying to liquidate it. So we want to have those conversations, not at 62, like, how do we fix this? But at 45, going, how do we land this plane with as little amount of turbulence so that you can enjoy retirement without feeling like you've had to recede in your lifestyle? And so we try to work a lot in that, like that preventative care almost, like instead of waiting till you feel the lump in your neck, like going to the doctor regularly. That's kind of the way we look at home equity, to make sure that, because you just don't know. You see people in their 40s and they have a plan, and maybe they get laid off. Maybe their company goes out of business. Maybe something else happens, or a major medical takes an income away earlier. So we always want to be checking in. We talk to a lot of our advisors about having an annual mortgage checkup. We do that all the time. Well, they'll just send us their clients' mortgage information, and we'll review it for them. And a lot of times we review and say, hey, they're in a great place. Don't worry about it. But when there is an opportunity or when something arises, we want to be able to take advantage of it, because we know that financial plans are great in theory, but they're hard in action. And so they evolve through the years. And we want to be just as agile with the mortgage to make sure as those things change, we're meeting that need for the borrower and for the financial advisor. Because sadly, most people think of their mortgages when they go to the bank. Like, I go to the bank for the mortgage, and for my retirement, I go to my planner. And those two people don't talk to each other. They're sometimes even adversaries. So we want to be that conduit that's a mortgage advisor for that financial advisor, and we all three are doing this in unison, so that I'm not enacting something that destroys something else, and it's all a large plan that works together.
I love that idea. It's somewhat new in terms of an annual mortgage review. It sounds so critical, exactly what you're saying around as older adults are planning for retirement. If they have a big, several $100,000 mortgage, where does that come into play, and how does that get paid off, and what's the best way to manage that? And I'm sure there's a million different plans and programs out there to address it, but having an expert like Matt who can go in and assess and work with your financial planner to determine the best way to manage that money is really super important, and how to leverage the equity as well.
Yeah, and we do. We talk about. I work with all different kinds of financial advisors, all different kinds of borrowers, and so similar to like children. Every child's different. Every advisor is different. Even with an advisor, every financial plan has nuance. And so we do have products that we use more regularly, but it isn't a situation where everybody gets the same thing. And everybody does the same exact thing, because we don't know everybody's financial history as one static thing. It's never that. There are inheritances, there are shortfalls, there are things that happen unforeseen. There are literally lottery wins sometimes. I mean, there's so many things that happen through the course of life that you want to plan for that alter things. And maybe I want to pay my house off as quickly as possible because we're making 2 incomes and everything's great. We have all this cash flow and we're saving correctly. And then boom, somebody gets hurt, or somebody loses their job, or somebody says, I don't like my career anymore. I'm going to go back to school and try something different. Well, that changes your financial future. And so being agile there, having the mortgage checkup, and we talk about our mortgage checkup just specifically. I need 4 things. All we ask for is their name, their address, the amount they owe, their interest rate, and their mortgage payment. With those 4 things, we can really tell if they have an opportunity or they have a shortfall, and we can work with them on how to solve that. It's not pulling credit, doing an application. A lot of people in our industry like immediately want to grab those socials and dates of birth and W-2s. We look at our mortgage review as more like a soft review. Like, hey, the broad strokes of your mortgage, ooh, wow, 6%. Oh, well, even in these elevated rates we've seen over the last 6 months, you'd be surprised how many people we still talk to that go, I haven't refinanced. What's your rate? 5.75. Oh, well, even at 4%, that's still a value.
Mm-hmm.
And did they sleepwalk through the last 2 years? Because we were at 2.75. You could have called me 2 years ago. Right?
Exactly.
We can still help you. But just asking those questions as an advisor, a lot of times is a reason to talk to your clients, which is speaking to the advisor community with purse strings. Like anytime you can get in front of your client, a lot of times that's where ancillary sales come from. You find out that there was an inheritance, or you find out that this happened, or a bonus. And then you can make sure that they're not just redoing the kitchen for the third time in 10 years with that money because they don't know what else to do with the money and they haven't talked to you. So having that mortgage review be part of your annual review process, or just a catalyst for a call, is a lot of times a discovery type situation for that advisor and the borrower. And a lot of times it comes back with us saying, no, like this isn't something you should even look at. So when somebody calls you from, cold calls you, or you get something in the mail that looks really shiny, like just throw it away. You're in a good position, and kind of reiterate that, because we see that a lot. People get convinced against themselves of something to do, because sadly my industry is filled with really great salesmen that will sell something that sometimes is more of a lateral move, but can convince, a citizen to do it. And they get through with the process of, what did I just do again?
Yeah.
This for saving $40. I don't think I really got a lot out of this. And
Right.
sadly, people are taking advantage of it that way. So
Yeah.
we want to work with the advisor to help that.
All right. So, and that's why we have purse strings approved professionals like you, Matt, experts that we've vetted that have come to the table and really are a wealth of knowledge.
I appreciate, we've always kind of steered toward more of a niche crowd and community. Most of our mortgage industry, there's nothing against it. I love my community. You'll never hear me talk bad about, quote, mortgage guys or mortgage cows. I love this industry, but most of them are focused on relationships locally with realtors. Mm-hmm. And there's nothing wrong with that. That's a real direct sale. But for us to have communities like this where we can provide education and support and drill deep with our referral partners. I have some referral partners that we've worked with for 12 years now. I've gone on vacation with them. I go to their kids' baseball games and graduations. We do a lot. I send them bourbon on Christmas, like in Christmas. So there's all these relationships we get to build with these advisors and our referral partners, because we do get to help families together, but we start to learn more about each other and what we're trying to accomplish. And that helps us just drill down even better plans for their clients. And so we've always kind of done this niche thing, and I've enjoyed it over the years. And I get to meet fun people like you all, and bark a lot into this microphone, but really helping families understand the power of home equity and the power of their home. Not saying you got to do everything every time, but when that opportunity arises, to take advantage of that, consolidate your debt, create cash flow, get some cash out for college, whatever it is, or be able to buy a second property that's income earning, or however that is, get money out so you could start a business. There's so many ways that you can use home equity. Giving people the power of the knowledge how to use it is really our passion.
Yeah, and it's interesting just really taking a step back. And as much as you wanted to make it homey and your home and the safe place and everything else, it's an investment, and it's such an asset in your life and, for generations to come as well. So it's not always, it's a home that my family comes to, and that's why I want to keep it forever. That's, the only thing it's there for. It's interesting when you have to look at your house again as an asset and as a moneymaker, but it can lead to a lot of great things as well.
Yeah, it is. And it's something that's not talked about. And a lot of times, because our industry, like I keep saying, it's kind of always lived in an island away from other financial fiduciaries. And I want to be that bridge. I mean, even if the business doesn't come to me, there's a division. So our parent company has different divisions all over the country. And our biggest division is in Baltimore, really Maryland and DC, but they're based kind of in Baltimore. We were there last week, and I ran a sales meeting for them just to explain this process. Like, I'm licensed in a lot of states, but the idea that I'm only one that's allowed to know this and talk to advisors or talk to the community like this is wrong of me. Ultimately, like me helping another loan officer or another financial advisor, specifically loan officer in my industry, understand that doesn't hurt me. Helping them doesn't hurt me. Helping a client doesn't hurt me. And so I always want to be free, like give free information, free wisdom, free game, if you want to call it, to people who are in this industry to know that connecting with real estate and connecting with, sadly, family attorneys to deal with divorce. The house is the number one conversation after the 401k. How do we split up the assets and who gets the house? Well, we want to make sure that is done efficiently because there's little nuances. Just to go off on a little tangent. Sometimes people put all the compensation to the one spouse in child support. Well, depending on the ages of the child, I can't use that as income sometimes. So allowing us to let them know, because the idea that a family attorney that deals with divorce with no lending guidelines is you would never expect that. So you go through this months and months of contentious negotiation and frustration and hurt. And you get to the finish line, you sign the paperwork, and then you call me and I go, oops, that was wrong. Can't do it. Then we got to go back there and dig everything back up and say, no, it needs to be in spousal support, not child support, or split up in a certain way, or it's got to be for this period of time. Don't take the lump sum, take the monthly. That's going to allow you to do all of those things are helpful because it's a tough situation. And when we can kind of dive in there and help it get rectified quickly so you don't have to go back through. Of course, attorneys don't work for free, so renegotiations are more costs, not just emotional, but financial. So people in our industry understanding that there are niches like that. And now I'm talking to mortgage people who prior didn't listen, but there are niches like this in our industry where you can be, yes, you make money off of this. Yes, you get loans off of this, but you can be an agent of help and change because you're helping people understand the industry and move on with their lives and establish what they need to do. I've just always had a passion for it. And I want other people in our industry to know that you don't just have to work with realtors. You don't just have to work with the people in your local community. There are other people that you don't even think about that need to know about mortgages. And then there's the direct to consumer, like purse strings, to empower that individual to know what to do, when to do it, why they're doing it, what it looks like, the programs that they're at. There's down payment assistance programs, first-time homebuyer programs, and home programs for veterans and first responders and doctors. All of these things out there that most people, if they just go to their bank and say, I want a loan, I got 20% down, they're just going to go, thanks. Yeah. And maybe they missed out that they could have put 5% down.
Yeah.
Saved 15%. 15% times 300,000 is $45,000.
Yeah. It's a lot.
That's better in your bank account than in equity, I think.
Yeah.
So especially if equity is going to build. So there's so much knowledge that I want to talk about.
Yeah.
There's just probably not enough time, but people just underthink about their mortgage so often. And they think of it as some static, like I have to have this amount of down and this is the right program. And it's like, oh.
Yeah.
There's different counties in different states. There's a loan program in Maryland, just for example. If you qualify for it as a first-time home buyer, they will pay off up to $30,000 of your student loans.
Wow.
They'll just pay, like you buy the house and they just pay off $30,000 of your student loans. And one of our branches that
Maggie's moving to Maryland.
They have this big check, like the Publishers Clearinghouse check. They write $30,000, like, Stacy Johnson, congrats, $30,000, and they liquidate your up to $30,000 of student debt. States all over the country have programs like this. They're grant based. They're done at the state level. So be interested in the programs that are available to you locally in your state. Ask questions because you may literally be leaving thousands of dollars on the table, or in this case, thousands of dollars of debt just go poof, and you're a homeowner.
Matt, you are a wealth of information. I'd ask you to give a few parting thoughts, but it sounds like you just have a wealth of information. We could go on all day. And I'm so glad you're part of our Purse Strings Network as our go-to expert on all things mortgages and all these types of programs. They're super important. We've lifted the idea that mortgage is not just your standard 30-year, pay it every year until you die, but there's a million programs out there that will help you really leverage your house value, make it affordable, explore the importance of really being a part of a community by purchasing and investing in real estate and in your community and in your family.
And I think we also can agree that, that's why a professional is important, is because none of these situations are cookie cutter. As much as, we're all kind of the same, every situation is so unique in itself. Every state has its own unique opportunities as well. So, talking with somebody just to know your options, because as much as we try to Google or get this information out, nobody's cookie cutter. And so we all have our unique situations to kind of work with and use that to our best advantage.
And the last thing I'll leave everybody with, hopefully, here is two things. And I know, we always used to joke growing up, the minister would say, "I got one final point," then he'd make 7 more points. So I'll try to not do that to you all. But number one, with the home buying process, my company is licensed in 49 states. Even if it's a question, this isn't going to be a situation where it's hey, a hard sell, of course. Even if you've never bought a home, or if you were maybe in a past relationship where that person was the financial head and now you're taking that over, and if it's question and answers, we thrive. Myself, I have 14 loan officers. We will educate you specifically to your state or your needs. But the last thing I say is, we always tell people, you can buy a house. It's never no. Worst case, it's not now. If you have a job and you make money, even if your credit doesn't qualify, we can help you, give you the building blocks to say, hey, you know what? It's not now, but in 6 months, if you do this, that, and the other, get your tax return. Don't buy lawn furniture with it. Stay some debt down, be strategic. We'll help you walk through that, understand your credit score. But we see, I just read this morning from Scotsman's Guide, the average rent nationwide went up from last year to this year over $400. And that's after the year before it went up $200.
Wow.
So from 2019, your rent in some places is almost double. It's expensive. It's getting more expensive, and housing is getting more expensive. And so having the conversations, even if you can't qualify yet, have the conversations and be like, I see the North Star of home buying. How do I get there?
Mm-hmm.
Either talk to us or talk to a loan officer that can be I get it. You got to take care of these two things. Once you get these two things taken care of, you're going to have the debt ratio for it. You're going to have the credit score for it. And now you have a goal set for yourself to be I'm going to be a homeowner by 2023. And I'm going to take the next 12 months to get my act together. And I know what I need to do. So many people, like the doctor, they don't want to go until it's really bad, or they don't want to do that checkup. Do this checkup now so you know how to get yourself in line, because that home buying process, if you'd have bought a home 3 years ago, you probably have almost $100,000 in equity built up just for keeping the lights on and the water running.
Yeah.
And you're not going to get that out of renting. You're not going to get that out of pretty much any other investment instrument. So getting to buy home ownership, even if it's with a low down payment, the appreciation we're seeing, and with the inventory being so low, it'll slow maybe the value add, but it's not going to stop. You're going to be buying in something that's going to appreciate. So please ask questions. Reach out to us if you want to, just so we can be an advocate for you all. It is true. I hope I'm pleading enough, but it is a real passion for us.
You thrive, the community thrives, their education thrives, the generation thrives, the ripple effect. The more I learn about this is really unreal when you just think about a home. What I want to say, a little purchase, because it's not little, but what one of these steps can really affect for your community and generations, which is absolutely mind blowing to me.
Yeah, and it's not as complex, but it is something you need to learn. And that a good mortgage advisor, loan officer, is going to do that with you and make sure that you are you're in the right place. And renting and housing is where we're seeing inflation is going to be a premium, because it's very expensive to build new homes right now. And so these existing homes, that's why they're snapped up so quick. But getting into one is you got your flag planted. You're going to see that asset grow. You're going to see that house grow in value. And 20 years from now, you'll be able to really reap the benefits of that. Maybe that helps you pay for your children's college. Because all that equity you build up, you can pull that out then.
Yeah.
You don't have to go into a bunch of other debt that's, a school loan. I always tell people that's till death. You get a school loan, and Maggie, you got a school loan in your name. No matter what you do, you got that till you're in the grave. Worst case with a house, I hate to say it, is you can foreclose on a house. You can just leave it. So, if you're talking about debt, I'm not telling you to put it all in your house and leave, but accessibility to debt on the home is better. So building that equity and be able to tap into it down the road for those things is better than that Sally Mae, because Sally Mae is, she's a mean one. She'll stick.
She's unforgiving.
Yeah.
She's unforgiving.
She'll stick with you until you're done. And I wouldn't be surprised if down the road they start pinning them on kids too, because the government owns that debt. And so That's another conversation for another time.
Yeah, it is.
Yeah, absolutely.
Yeah. Well, thank you so much, Matt. We love that you're part of our community. We love the expertise that you bring to the table. We love the loan officers that work with you and stand behind you and help women and families get mortgages and invest in their home and in their families and in their communities. So thank you for being one of our Purse Strings approved professionals and part of our community.
Thank you guys so much for having me, and even for you both personally, any questions you even have. My door's open. You have my cell phone and my email, and you've seen my face.
Yeah, we know where you are. So,
yeah,
all right, well, let's bring it on home. Thank you, Matt, for joining us today on our podcast, Women and Money, the shit we don't talk about, because we are talking about it.
Talk to everyone in a couple of weeks. Bye now.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.